Bueno, yo creo que vamos a ir empezando.
All right, then, we may begin. Good morning to you all. My name is Lorena Martinez Olivares. On behalf of J.P.Morgan, we would like to welcome you to the second seminar that we hold this year in Barcelona in this occasion, and let's hope we can do it again in a few months. We expect to be done by 11 with the presentations. Then we'll open some Q&A and we'll offer you coffee. You're invited to join us after 11:30-ish. The last part of the summer and in this month of September, we've seen how volatility is a reality. So we deemed it was timely and most appropriate to join together to discuss how we see things from a macroeconomic perspective and how we see financial markets. We would like to share with you a few ideas about investment related to this environment. I am sure that we all have in mind concepts like the one I mentioned, volatility, correlation, diversification. And our idea here is to put in context all these contexts. We will start with Manuel Arroyo, our strategy director. I'm sure he's well known to you all. He's going to talk to us about the different regions, the status quo in different regions, the macro data, and their perspective in the financial markets. Then we'll move on with Jonathan Sachs, the head of product specialist, the product specialist team's absolute return in income. Fixed income. This is an asset that in the recent past few months has been very volatile. It has not become the buffer that some clients would have expected. However, well, there are still opportunities, even if there are risks also. We also have Olivia Mayell, the global multi-asset head. She's going to talk about J.P.Morgan Global Capital Appreciation Fund, which is a new idea that we would like to share with you. This is a global macro multi-asset fund. And given the context, given the environment, we deem it very appropriate. This fund is 3 years old, will be 3 years old in November. And since then, it's yielded very good results in this year 2015, and it stood the drops and very robustly so it is a fund well worthwhile considering for your portfolio. So not much more from me. I would like to hand over to Manuel in a minute, and let me just say that in the information that you've been given there are some cards for you to jot down a few questions if you're interested, and give it to the organizers, and then myself, well, I will read them myself when we have the Q&A, when we have the debate. There's also a quality survey, because of course we want to improve. So if you kindly fill it in, also give us your suggestions, and we'll take them into account. Manuel, all yours. Good morning, ladies and gentlemen. Thank you very much for joining us. Before I get started, let me remind you that there's a program, and I suppose that you've signed in already, and that's what we do in all the publications related to strategy and economy. There's a novelty that we introduced the past time in Barcelona, which is, and you know, this is available for all the Apple users. It's totally free, and in the bag that you've been distributed, there's information as to how to get this app, this app, and all the benefits. It's the digital version of all the reports that we forward to you via email and on paper, which is the market guide, the guide to the market. So sign up, because it's totally free, and the program is in Spanish. So I hope you like it. and you use it. I'm expecting to stick to the time that I've been allocated, 20 minutes. And last week, when I was preparing for this presentation, I said, okay, I have to speak about China and Europe and the markets. Let's split the time, my time. And the question in mind, well, I'm sure it's the question you all have in mind, which is, are we done? I mean, is this the end of the cycle? Because even the problems, China, the US, will it grow, will it not, what's going to happen with the rates? But the stock exchange, that's the question, will it go up or down? We believe that the bull market is still here to stay, and I think, let me state this loud and clear, because it's the most important message from me. There will be volatility. International markets are distortioning all the markets. The stock exchanges are not as cheap as 4 or 5 years ago. Of course, it's going to be more difficult and more important to be selective, asset-wise, market-wise, securities-wise. In our opinion, the market will keep on increasing. The market is more mature now than a while ago, but yet there is a long way ahead. These are the topics that I would like to discuss today. As I say, there will be a lot of volatility, even if the markets will increase. This is the beginning of a new era, a new world, which is a risky one, much more than before. There's something that probably you've been realizing already, the divergence between the developed economies, macro level, and the emerging economies. I would like to talk about the central banks, the Fed, the European Central Bank, and the potential rates increase in the States. I'm going to talk about Europe and the periphery and the implications when it comes to managing funds and managing assets. So, first, volatility is back into the markets. The markets are dropping a lot, but we came from years that, had low volatility, and we got accustomed to that. The markets would increase, and we didn't see any drop above 10% in the US. It didn't happen for a long time. And here in the graph on top, you see the different volatility indicators, fixed income, and the different securities. You see the levels so low. I don't know if the pointer is working here. This is the raw materials, and you see how the volatility boomed. And you see that this summer the volatility of securities has changed. A good manager would say that in such an environment with drops, the opportunities arise. Many managers are realizing that this is good for their portfolios. Then you see the evolution of whatever happened. Not only in Spain, all the markets dropped. So there's been like a rebound. And it seems that now markets go back down. And we've seen also this summer that, these are yield, aggregate yield. But we see that the raw materials go down, and fixed income here in the middle has not been a buffer. When the stock markets go down, people go to government bonds, but that's not what's happened. All the assets have had negative yields because, the spreads were so low that there was not such a long trajectory to get. To get the recovery. Let's put everything in context. This is taken from the market guidelines, and this is an information that we use, to explain to people that are not that familiar with volatility, to talk about what's happened in the past 35 years. This is the European MSCI index. We have information from America, and it's the same. It goes back to 1980, and you see the yields year after year. So these gray bars, positive, and negative. This is the yield, MSCI yield, year after year. And the red dots are the greatest drops for the different years, according to MSCI. And I've marked some of the years that I'm interested in stressing, examples with drops 20, 30, 26%, MSCI, and with these yields, if you take the average of all these series, you see that in the past 35 years, the average drop is 15.6%. That's the average drop. If you, get rid of some years, because some years would drag. Okay, take the average, and then it's 12%. So volatility is normal. In the past years, maybe we got accustomed and there were no drops. But if you take a long series, even in the best of the years, the stock exchange goes down. January to December, there are always drops, and there will always be. So the clients need to get used to that. We have to live with that. Another question, as I said before, is this the end of the bull market, as I was asking myself before? Here's the study, and it's quite interesting. This is the American market. It's the beginning of the 20th century, and we've taken the largest correlations, the bear market, a drop of 20% or more. So that's what you see on the top, SP 500, and you have the booklet, so you can check it later on. These are the 10 corrections above 10%, and recessions are duly signaled. What's interesting here? Absolutely all these corrections of 20% or more. At least one of these four conditions apply. Either an economic recession, or a peak in raw materials, or an increase by the Fed, or an extreme valuation. In these cases, at least one in four of these conditions apply. But today we can say that that's not the case. Of course, there's not a peak in price of raw materials. Adjustments by the Fed are not to be expected. The valuations are not extreme. The markets are not cheap, but still, and so far the environment is not that of a recession. So is it impossible to have a 20% drop? No, it's not impossible. But it would be the first time in 100 years that we would see a bear market. So more than 20% drop without one of these conditions or any of these conditions applying. If we go into the macroeconomic details now, of course, we talk about the US, Europe, and emerging markets. Well, now we have to speak about China first. Why? Because I think it's the excuse, or what helps us explain these drops. The main thing, the main conclusion is that this highlights the fact that the problems and transformations in the Chinese economy, it was capital dependent, investment, infrastructure, and now it's moved more toward consumption. They depend on consumption, and that is going to have a global impact. That no doubt about it. And there's been a drop in the Chinese market, and we need to mention that, and it started long ago. This is one of the main indices, and you see the peak here and the drop. So you put it in the context when the Chinese market, fixed income market dropped, the levels were very high. They had increased a lot before. And there is another line here, which is the leverage level. So what we saw in China is that most of the people that would invest in equity, that's what they found. But the impact in the market is going to be limited. Why? Because so far the investment in equity in China only accounts for a certain percentage of the wealth in the Chinese economy. Here in the West, people invest in equity, and that's a minority thing in China. It may have an impact on the consumer confidence. That might be a reality, but Well, in terms of economic growth, what's going on in the Chinese market is not going to have such an impact. But the title is, lights and shades in the worldwide economy. So China has its good things and its bad things. Problems, the indebtedness in the private sector, not publicly, but the companies there. Well, we see, and it's concerning, their degree of indebtedness. Also, the currency. You see this here at the bottom left quadrant, the currency is more expensive, and since the country is an exporting one, well, that's an issue. More concerns. Lack of credibility after the way in which they managed the crisis this summer. The stock exchanges were falling and falling, and the, decision makers applied a certain solutions. They devalued their currency, and it was not a solution at all. There's not that much debt there. They have the reserves. So if there's a slowdown, the government has the power and the possibility to actually get the economy back afloat. But we see the crisis in the summer, and you see the way they managed it. It's been a complete disaster. Well, then you wonder, will the government be able of managing this economic transitions? Anyway, there are good things, positive things in China, indebtedness in the private sector, as I said, but family-wise, they save a lot. No mortgages, and there's no nationwide indebtedness, so there's not that much debt on their GDP. Problem in China is, if you wish, just to close this chapter, the expectations for the coming years. Well, growth will be smaller than in the recent past. We still think it's going to be 6 to 7%. People are saying 4% growth, but the problem is the deflation first, and second, the fact that so far this smaller economic growth has been reflected on the balance sheet of the companies, but not in the labor market. If you hear presentations about China, many analysts say that it's very positive. It's very positive, the fact that, jobs are being created. Maybe the most important question mark is the impact on the debt rate and the capability of the government when managing the problems with unemployment. That's one of the mysteries that we will have to wait and see. The rest of emerging markets, of course, are suffering from the impact because there are differences, but in general terms, they are going through, problems. You see a comparison here, the domestic demand, developed markets, not very high, but positive, and compare it with emerging markets demand. Well, they are having all sorts of problems, cyclical issues, the drop in raw materials, also the increased dollar, increased rate, or structural problems, factors that are purely demographic, or population aging, or productivity problems, or debt issues because all of the money coming from the U.S. and the rest of the world, and that's now generating these adjustments that need to be solved. So cyclical problems in emerging markets and purely structural ones. And the key for us is to distinguish that. Of course, we tend to, pull them together, but there are emerging markets on emerging markets. In some countries, rates are going up. In other countries, they're going down. There might be deficit or surplus, and it's a different story. Reforms are being applied in some countries and not in others. So it's going to be fundamental to distinguish them. But from an investment point of view, and I imagine that my colleagues will touch upon that later on, there's still a great deal of uncertainty related to emerging markets, and that's a concern for us in the coming quarters. Another aspect is the lack of inflation, especially in the developed markets. You see that in the top graph, the development, the evolution of inflation in developed economies. From the 1990s till 2007, the average was 2-ish%. 2009 till 2015. Inflation rate, we've created a new level. It's 0 now. So the risk of deflation is limited, I guess, given the point in time, inflation should go back up. That's the expectation. But if we are wrong, the world is so leveraged that, a deflation scenario would be a catastrophe. But our expectation is for inflation to recover, and the market expectations go beyond that and tend to point to this is United Kingdom, the United States, and the Eurozone, and those are the expectations. The United States, of course, we're not concerned about them. GDP has been reviewed 4%. Expectations for this quarter slightly lower, but they're doing fine in the U.S. labor market, real estate market, trust, a lot of savings. So internal demand will probably keep on increasing. So it's not that we are concerned macro level-wise. U.S., what's the Fed going to do? That's the question. I thought that they would raise in September, and I was wrong. And I think they got it wrong. Allow me to say so, but if you see how the markets have reacted, and the Fed itself, some of the members, had to reassure the public, and they say that probably they will increase the rates before the end of the year. In our opinion, an economy that's growing at the 4% rate, why have rates at 0? September, December, when, we probably all agree, and the Fed has said so, that the pace is going to be incremental. So it's a trust message. We're doing fine in the U.S. We need higher rates, and the markets will grow, but they'll take it slow, really, and they've announced it. So small increases in the long run. Important here, we will see for the first time in many years different monetary policies. So far, all had their rates at 0, or were implementing quantitative expansion programs for the monetary basis, and that's over. That was going to have many implications in the emerging markets, currency curve. We're going to see that, and the expectations, not just the Fed, but also in the UK, the rates will increase, not just in terms of monetary policy. One of the things that we are seeing, and this is going to be a trend that will stay, is this difference between US and Europe, probably because Japan's having problems vis-a-vis emerging economies. There's this gap. There's like two worlds. Many economists with their studies, they've reached these conclusions. It's normal. So there's no need to worry. When there's a recession, when there are problems, we all go in the same direction. But when there is a recovery, economic expansion, then each country takes its own path. And we see here the US, the UK, the recuperation. That's the recovery line, the richer European countries, and then the periphery and Japan that, follow their own pace, their own rhythm. So that is the gap, important to take into account. United States and UK and the rest. In Europe, we've seen that growth rates have recovered. In purple, you see the GDP recovery, and what's important here is the correlation between the GDP correlation and the credit. And we've said it non-stop. Credit needs to flow. The banks need to foster that. But that is an example. That is a proof. What's positive here? The levels of credit demand that we are seeing for the coming months is high. That is a survey among the banks. They were asked about credit and housing, whether they're seeing an increased demand. And you see the levels. It's top level compared to the past years. So if the correlation stays, the GDP should recover. There's the European Central Bank behind. We have the benefit of the euro falling. So there are many reasons for us to be optimistic in relation to the eurozone. Also, probably, that in Spain we are used as an example in the Eurozone. And part of the merit here had to do with the reform agenda. Many studies tend to say that that's not the case. The reforms in Spain are beneficial, but that's going to have an impact in the longer run, not now. We see a recovery of the real estate market, internal demand also, but the expectations for Spain are positive also for the periphery, the rest of the periphery. So economic indicators all in positive. And this graph seems to be busy, but it's very easy. It's the difference between the periphery and Central Europe. And you see here, down here, counterintuitive, but the periphery here has been a growth engine. Not just Spain, but other countries are really pulling the Eurozone up. When we were asked about the market expectation as far as the European stock market, well, we tended to resort to MSCI. This is the green line. But there was a problem with this stock market recovery because the markets were not following. You see here this peak. These bars are the corporate profit bars, and these were parallel, so they were hand in hand in the U.S. But in Spain, in Europe, the stock markets have increased, steady line, but the profit, has not. But the contrary has happened, and what we're seeing now is that this is starting to change. Managers were not that optimistic in the past. I said that before. It has to do with the euro falling, the recovery of the raw materials prices, and we see that this is going to stay for the coming months. That's fundamental, not just in terms of sales, but also in terms of margins. Many people were asking, how is it possible that in the U.S. the margins are up here and in Europe the levels are down here? So we will see how this is going to change, and then in the equity market it's going to change. Stock exchanges, they're not cheap, but they're not expensive either. And you see that the UK, the US, the European market, and the emerging markets, in the three developed ones, we use these concepts, and we see the evolution of this ratio, price-benefit ratio. We see in the UK it's the average, the US it's below, and Europe it's an average. So it's not cheap, but it's not an expensive market either. Emerging markets, as is the case, we see that this profits, it's difficult to determine, so we use this ratio, book value ratio, and I don't know if you can read it, but it's the same if we compare the levels with 2008 or 2001 or even 1998. So you can imagine situations that were much more complicated than the current one. And what's important is that these were years when the emerging markets recovered a lot. So, the analysts say that many macro problems, but from the assessment point of view, we take a look at the past 30 years when the valuations have reached this level. The yield has been better always after that. So that's my take-home message. And then fixed income, and John will touch upon that in his presentation. There are opportunities, especially in high yield. There are a lot of high yield opportunities, and you know that the IRTs are in historical minimums. There's been movement this year, but in real terms, the yield is not attractive. But we see the result of volatility in the past few weeks in corporate debt. Corporate debt, you see here, bottom right, see the evolution of IRTs in high yield. High yield, European market, American market, and energy sector in the U.S. market that has pushed this high yields margins in such a significant way. But we see opportunities there. So that was my part of the session. I'm done here. So let me just rephrase what I said in the beginning. We believe that the cycle of this bull market will continue. We firmly believe on the developed markets, American and European markets, there will be a lot of volatility. We need to take into account that yields will be smaller, no double-digit yields, 5 to 10 tops. And these will be yields that we will have to fight for and struggle for them and suffer to get to them. But, we have to, hold on tight. Many managers are making the most of the corrections to invest. The world is growing. The US, Europe is doing fine. The rates will continue at zero. Virtually, central banks are, telling us that we need to assume risk. And that's the idea. And then we will have a Q&A later. So I'll leave it here, and I would like to hand over to Jonathan Sachs. Thank you.
Good morning, everyone. Can you hear me? Thanks for having me here today. So, always good to be back in Barcelona. The last time I was here was about 3 months ago. I came on holiday with my wife. So, this is the first time that we're away from my son. My son's 14 months now, and I check a bag with the airline. They lose my luggage when I get here. And I have all my clothes. I have a camera that we brought. I even put my wife's makeup in there. So 3 days of me having basically no clothes in Barcelona. The one lesson that I learned is that it was my fault I lost my wife's makeup. So, look, this is an interesting time to be in fixed income. You think about fixed income markets today, and clearly the most challenging they've been in, 4 years since the European debt crisis. There's never been a time that I can think of in the last 4 years where we've had fundamentals that have been this detached from price. Let's talk about treasury markets or bond markets, right? Where both markets are pricing in 100 basis points less in GDP growth, basically no inflation, and no possibility that the Fed is going to tighten rates. Look at US high yield in terms of corporate markets. You have spreads that are pricing in recession-like default expectations with very little recovery. There's really not a market in fixed income this year where you've even earned your coupon. Most markets are flat to negative on a total return basis. But yet the biggest challenge that I see for fixed income investors is from an asset allocation perspective. You have not had the proper hedge to risk assets, as we've seen in the last 6 to 8 weeks, that we have expected, that we've anticipated, because coupon income is so low and central banks have distorted relationships across sector. So it is because of this right now, with an opportunity set that is better and more attractive than it's been in 4 years, why I think absolute return fixed income is more relevant now than when it was talked about 2 or 3 years ago as simply a hedge to rising rates. Because investors are looking for low volatility. Investors are looking for coupon income that is not just tied to the direction of rates. Investors are looking for a proper hedge to risk assets, and that final component, something that can actually capitalize on this mispricing instead of hoping that we don't just experience the drawdown with it. So I'm going to spend the next 5-6 minutes discussing the markets, then I'll take you into a bit on our process, on our team, and then positioning and some performance at the end. So what are the 3 themes in markets? And Manuel touched on most of them, but the Fed, commodities, liquidity. Those are the 3 things that I see impacting credit markets globally. Let's start with the Fed. So you'll look at this slide here, and what I realize is these things goalposts. This is American football. We're the only country that plays this one weird game where everybody else plays the other kind of football. That's what these goalposts are actually referring to. But regardless, over the last 3 years, since Yellen said, we're going to be communicative, we're going to be transparent, all they have done is confused investors. 3 years ago, they said when unemployment gets to 6.5%, that's when we're going to start raising rates. Now remember, the Fed has 2 mandates: employment, full employment, and moderate inflation. That should be it. So once we've reached the first mandate, we will raise rates. Now let's instead go to a considerable time after the QE3 ends. Well, it ended 12 months ago, so we are there. Now, let's say instead of talking about employment and asset purchases, let's go to inflation. Now we want to wait till we're at 2% inflation before we feel comfortable enough raising rates. And now we're here at the very end where we're monitoring developments abroad. We're more concerned on oil, we're more concerned on the US dollar strength or global equity volatility than we are on the two mandates that the Fed has, which is employment, which we are at full employment now in the US, and moderate inflation. All this has done has confused investors and reduced the credibility of the Fed. Markets were ready in September for the Fed to raise rates, and by kicking the can further down the curve, they've just exacerbated the volatility that we're all experiencing. Manuel touched on some of this, but let's look at those back to the dual mandate of full employment, moderate inflation. GDP growth at the end of the first quarter was second quarter was 3.7%. That got revised last week to 3.9. You're talking about 4% GDP growth in the US. That is very strong. Unemployment rate at 5.3%, 500 basis points below where we were 6 years ago during the credit crisis. Inflation, hourly earnings, 2% higher. Consumer confidence, the highest it's been post-credit crisis, and the housing market is strong. So consumers, 70% of the US economy is consumer spending. Consumers have more confidence because they're making more money and their home is worth more. Yet we have recession-fighting tools in place. We have 8 years now of zero interest rate policy, 3 QE programs, $4 trillion balance sheet, and the Fed feels they cannot raise rates, and the market continues to discount this. After Yellen last week said, now it's on the table for December, the market is still only pricing in a less than 50% chance that the Fed actually follows through. I get asked the question all the time, what will the Fed do and when will they do it? The truth is, I have absolutely no idea anymore. Because everything on this page would tell you they should have done it 12 months ago, and instead, you have debt bubbles forming in auto loans, in commercial real estate, in corporate credit, and it's a result of investors having to find yield wherever they can. Second issue affecting credit markets is liquidity. I think everybody knows this story pretty well at this point. This is outstanding debt in fixed income markets, and this is dealer inventory. Dealer inventory is 1/6 of what it was pre-crisis. Outstanding debt is 2 times as high as it was. That story is well known. Let's talk about who's buying the debt, not who's inventorying the debt. 60% of buyers of US Treasuries are non-US buyers. 60% of US Treasuries that are traded are done by high-frequency traders, of which 3 firms dominate that, and they trade $4 trillion in US Treasuries a year. 80% of investment-grade bonds are traded by the same 7% of buyers. This math is what makes this so difficult. Because we have an ETF and a mutual fund to represent every part of the market, and you have central banks that are trying to help manipulate currency, you have the same buyers in this market that are dominating the liquidity, and you get periods of volatility that are exacerbated by the fact that there is a very poor liquidity environment today. The third story is commodities. So we creatively titled this 3 C's: China, commodities, central bank. Obviously, oil has been the story, certainly within high yield markets in the last 12 to 18 months. What's interesting is look at credit spreads across these 4 sectors. And let's think back to value. Instead of thinking about volatility, where are we getting compensated for risk? Investment-grade bonds, whether it's in Europe or in the US, supply is at an all-time high. Issuance keeps coming, and there's not enough buyers on the end to digest that. Hence why you see spreads higher, while the correlation to rates has never been stronger. You have now the spread between high yield and EM that it's the widest it's been in 3 years. Yet, higher rates, a stronger dollar, commodity pressure should be impacting emerging market debt more so than high yield, but yet high yield spreads are now 600 over. That's an 8% coupon for US high yield. That's why this is such an attractive opportunity, is because you are getting paid to carry that trade. Okay, so energy is affecting high yield. Let's take energy out of it and look at high yield spreads ex energy. 500 basis points over as of yesterday. The default rate outside of energy on high yield over the last 12 months has been less than 1%. We anticipate it to be no more than 2% over the next 12 months, yet we are pricing in a 4 to 5% default rate with a 40% recovery outside of energy names. I get the pressure with energy, but high yield outside of it is such an attractive opportunity today. And finally, you'll see OAS, that is spread. High yield CDX is just the broad index. It's the synthetic index, and you'll see how much that has diverged because of energy names, which make up 3 times the index than it does the synthetic equivalent, and also because of the liquidity of cash bonds moving out of those markets and putting pressure on prices. Finally, in terms of high yield, I want to look at high yield relative to rising rates in the US. This is the last 30 years, the last 4 times that the Fed has raised rates. 2 different times, in 1988 and 2004, the economy was improving, the Fed was transparent, they raised rates in an orderly manner, and high yield performed well as credit spreads tightened. When did high yield not perform well? 1994, when the Fed raised rates by 3% in 12 months, blindsiding investors as they were expecting rates to come down, and at the end of 99-2000 during the tech bubble and the global recession. So today, if we think the Fed is going to be communicative, like they were here, if we think the US is not going into an economic recession like we were here, and the spread today is 100 basis points higher than it was at any other time period pre-Fed tightening cycle. You've never gotten paid more going into a Fed tightening cycle than you are today. This is why I think relative as a hedge to tighter rates in the US, high yield makes a lot of sense in this environment. So I mentioned in the beginning, what is the answer? It's a confusing environment to be investing in fixed income, but investors are still looking for those 4 things. Coupon income, without directionality to rates, low correlation to equity markets, the opportunity to capitalize on this sell-off that we've seen, and low volatility. So when we think about unconstrained investing, we bifurcate it into 2 areas. You have total return strategies, right? These are cash plus strategies. They're unconstrained from a benchmark, but they are generally fully invested, higher volatility, higher return targeted strategies, which are a perfectly appropriate part of a broader diversified fixed income portfolio. Where we think that we're different is absolute return fixed income. Of the 150 managers in this space, we believe we're one of the few to really look at absolute return in the form of multi-scenario investing. How can you drive a positive return regardless of what rates and credit spreads are doing? And you do this by having not just tactical beta rotation, but having long-short relative value trading that is uncorrelated to general beta markets, that can drive alpha in a variety of environments. That has very little duration, small duration band relative to 0, and that is systematically hedged, looking at a way to systematically dampen volatility and reduce risk in the effort just simply to preserve capital. So our team, we manage $28 billion across our platform, basically one flagship portfolio. We've been doing this now 8 years, since July of 2007. Where we feel we're a bit different from the 150 other managers is that we are our own distinct part of the firm. We are not a part of the general and traditional fixed income and liquidity businesses at this firm. We are a boutique, our own P&L, our own risk systems, our own performance metrics. To be a true absolute return investor, we feel that you need to think only about absolute return fixed income as opposed to leveraging best ideas across a bunch of long-only different types of strategies. Here's a view of the team. I show you this more to get a feeling for what we're investing in than the personnel that are involved with it. But you'll see everyone here is focused on alternative markets or alternative trading techniques and has a background in both cash bonds as well as synthetics, so understands the relationship between traditional and alternative markets, which is so important in this environment. We're investing in things like securitized bonds. These are structured products, agency and non-agency mortgages. We have a macro team that looks at currency and rates and curve positioning globally. Commercial real estate, long-short credit. This has probably been our core competency over time, as well as insurance-linked securities. All of this team comes together to try to drive alpha in esoteric parts of the market where we feel we have an information advantage, where we feel we have inefficiencies. There's 3 goals of this strategy when I think about it from an objective perspective. 1, coupon-like returns on an annual basis, doing it with low volatility, and having no correlation to traditional fixed income markets or traditional equity, so this can really be a true diversifier in an asset allocation when it is so hard to find true diversification. So since inception, annualized return has been 3.5%. I call that coupon-like returns, with a volatility meaningfully below your traditional fixed income and equity indices at 1.95. And this is the most important piece. Zero correlation to traditional fixed income, zero correlation to global equities. So any slice of this as part of a broader portfolio will improve risk-adjusted returns over time. To touch on our process as a reminder for some of you, we have three different parts of this portfolio. I compartmentalize it into three areas. We have our beta, which is our tactical rotation, looking at risk markets, identifying where are we finding the most value. Where is compensation the highest and fundamentals the strongest? What's different for our strategy relative to others is that we're not just going to invest in each one of these areas and rotate a bit out of one versus the other based on what's happening in trading today. We're going to identify the one or two areas where you are getting the best proxy for risk in the market and concentrate in that area. This will generate about 75% of the returns over time for the strategy. This alpha, that's the long-short relative value trading. This should generate anywhere between 25 basis points in a benign environment to as much as 250, 300 basis points in a high volatility, high conviction opportunity set. This is how we drive those uncorrelated returns and really bring diversification into the portfolio. The final part of the portfolio is the hedging, the systematically hedged risk. So we use cash. It's been as high as 85% of the fund back in 2008 heading into the credit crisis. It's been as low as 15% of the fund in 2009 when we had a once-in-a-generation opportunity in credit in front of us. But we use cash to dampen volatility, but also to be a liquidity provider in this environment where there is very little of it. Trading almost $30 billion of credit globally, we will get those phone calls when a mutual fund or an insurance company or an ETF needs liquidity and they need it immediately, and they know that we have that cash to be able to provide it. To give you an idea of our positioning today and how that's changed over the last 12 months, you'll see up here our cash position, which last summer was as high as almost 70%. This is volatility in fixed income markets on this axis on the right. But you'll see what's happened since March. After building up risk positions as markets were collapsing a bit at the end of last year, we've gotten a bit more conservative over the last 3 or 4 months. We have increased cash. We have reduced our exposure to things like U.S. energy, high yield, European credit. But now, over the last 4 to 6 weeks, we have found opportunities to get invested, put 5% of that cash to work in areas like distressed ETFs and closed-end funds that have sold off, high-yield spread swaps, high-yield beta. So across credit markets, we've put money into non-agency mortgages, looking for areas of the market where we're getting uncorrelated returns. To where now today, that alpha sleeve is almost 27% of the portfolio. This is that long-short relative value trading that's so important. And the cash has come down. Cash today is 35% and moving lower. We have monetized those short positions as they've worked. I'll talk to you real quickly about 3 trade ideas. The first will be non-agency U.S. mortgages. So this is a really interesting area of the market. It makes up 8% of the portfolio today. I like it because it's a bet on the U.S. housing market, which is just getting stronger. I like it because it does not have a lot of correlation with interest rates as it's floating rate. I like it because it doesn't have a lot of correlation with credit markets, basically none. And the return expectation on this portfolio is 5 to 7%, so you're getting healthy yields in this area of the market. Second trade I want to highlight is looking at European high yield. So this index right here in blue is crossover. That's on this axis right here. That's the best proxy for European high yield. This index main is going to be on this side, which is going to be your best proxy for investment grade. Instead of making a directional bet on European high yield, all I think is that this spread is going to contract. And you'll see different periods. Last summer, this spread was much tighter, and then all of a sudden it started to widen out, and we got invested in this area. Again, it started to tighten in here, and then this summer it is now widened again. You're getting paid almost 3% more to own European high yield than you are investment grade bonds. Yet they have very little correlation with European rates. The ECB is going to continue to buy for the next 12 months, which is going to be an automatic bid to higher yielding securities. And growth in the Eurozone is on the way up. So these are 3 reasons why we believe this spread will continue to tighten, and we're not making just a beta directional bet into the market. Final trade I want to talk about is what we're short. Biggest short in the portfolio today is Mexico CDS. The reason we're short Mexico is because if commodity markets continue to collapse or the dollar strengthens or rates move higher or you get more geopolitical risk, this hedge will work in a very, very good way, and it's cheap to carry. 100 basis points is all this costs on an annual basis to be short. Look here, in October of last year, this was 80 basis points to short on an annual basis. Now we're looking at close to 150 if I were to move this line further out. And whether it's energy last year, or the dollar rally in the spring, or the China slowdown today, this hedge works in a variety of different ways. So when I think about shorting something, I want to think, what is the most liquid way to do it so I can sell this if I need to? What's the cheapest carry so that way if this does not work out, I'm not losing a big negative yield on the position? And what's convex? How is it going to work in a variety of different situations? So in terms of positioning, this green is the beta in the portfolio, the blue is the alpha, and the red is the hedges and cash. And you'll see it's pretty dynamic over time going back to 2007. And you'll see there's these big patterns of when we build risk up and then we take it down. 2008, the fund was extremely conservative going into the credit crisis and then built up a massive position in credit going into the first half of 2009. Similarly, in 2011, the European debt crisis, we were buying in the first 6 months of 2011, and by the middle of 2012, the fund had its largest market exposure that it had in the history of the fund. Today, we're going through a similar time period. What happens along the way is that we do not time that trade perfectly. What we identify is that you see spreads today at 600 basis points over treasuries. You're seeing value in securitized markets, in corporate credit. You're seeing value in short CDS. You're seeing value in commercial real estate. There are opportunities today that we did not have 18 months ago, and the reason why we're so convicted to have almost 70% of the portfolio invested for the first time in 4 years. In terms of a little bit more granularity, the biggest position we have in the portfolio is high yield. I've explained why we feel that is such an important place to be. After a 17 straight month now of a cumulative negative return for high yield, we expect the performance in this sector to be very, very strong moving forward. 10% short and 8% long on the relative value, long short credit, and then short emerging market debt. Those are my high conviction ideas. Long high yield, short EM, and find as much relative value trading as you can in this market. In terms of performance, we provide this every month to our clients. Every basis point is attributed every month across the beta strategies, the alpha, and the portfolio hedging. You'll see the numbers up here on a gross basis. Years like 2008 or 2011, when you see massive volatility, the fund is just trying to preserve capital and not lose money for clients. Then there's years like 2009 or 2012 coming off of that volatility, getting invested and capitalizing on that opportunity. Today, as of the end of August, we're flat to slightly negative depending on the class of share. But I think we are positioning ourselves for another cycle like we've seen before, where we see opportunity, we are not afraid to put that money to work, try to do it in a diversified way to where you're not just making a directional bet on credit or on interest rates. And finally, I'll end with this slide. This is looking at performance relative to volatility over time. The blue line is volatility in fixed income markets, and the orange line is the 12-month return following that date. So what this slide is intended to show you is when we see volatility, are we capitalizing on it in the subsequent year? So when volatility is below average, this fund has annualized a 2% return, modest, but yet positive, trying to reduce volatility in those environments with the lack of opportunity set around us. But when volatility has been above 100, which is the average over time, that annualized return went from 7%. I also called this out. This is how quickly markets can change and return expectations can change. In the summer of 2011, the one-year return went from 1.6 to 9.6 in 1 quarter. This is why it's so difficult to time this type of strategy, because markets move quickly, opportunity sets close quickly, and we are there to try to be as tactical as we can through it. So in conclusion, my message today is that when you think about absolute return investing, it remains such a vital component of a broader portfolio, in my opinion, as a way to diversify a portfolio when everything is so correlated, to try to drive positive returns relative to interest rates, and capitalize. That last part is to capitalize on an opportunity set that we have not been as convicted in the last 4 or 5 years as we are today. So that's it. Thank you very much for the time. Olivia, I'll pass it on to you.
Well, good morning. For those of you with very busy days, I have some very good news for you, which is I'm going to try and be quick. But the problem with being quick is that I will fall out with the people translating my English into Spanish. I would love to present to you today in Spanish, but I'm afraid that my repertoire in Spanish is vale, gazpacho, and sevi ballesteros. So after that, I have nothing else for you. So I must apologize, but I will try and be clear as well as quick. What the team wanted me to talk to you about today is a portfolio which hopefully can help you when markets are quite volatile. The Capital Appreciation Fund I'm going to talk to you about today is a macro fund. It's up 14% this year to date. It was up 4% in August. Those are the eye-catching numbers. Now hopefully I've hooked you and I can tell you how it is that we've been able to manage this portfolio. Well, the first piece of news is that a multi-asset portfolio is something which the industry seems to be moving towards. I think one of the consequences of the great financial crisis is that more and more people come to investment managers like us and say, help me. Not for the core, straightforward parts of their portfolio, but for where we can help people to achieve different outcomes in their overall portfolio management. So this flow of assets from traditional fixed income and equity portfolios into multi-asset funds isn't people asking us to do their job for them. It's asking us to help them to achieve slightly different outcomes. And that outcome is what you see on the chart behind me. What this shows you is that for the Capital Appreciation Fund, in very good market conditions on the right-hand side, and this is months when equities are positive, bonds are positive, and both are positive together, performance is pretty good. We can keep up. But more importantly, what happens when the world is a little bit scarier and things are harder? And this shows you in periods when equities have done badly, when bonds have done badly, and when both have done badly at the same time. And that's what we're all worried about at the moment. What happens when a negative correlation breaks down between those two asset classes? And in those environments, over multiple periods of time, we've done okay. So it's not just about August, it's not just about this year. We go back over the last 3 years, and this has been the case time and again. And so why do I think this is useful? Why is this not doing what you do? Well, first of all, for people that are running portfolios of equities and bonds and alternatives, this is going to be something that is going to diversify your portfolio. It behaves very differently, and I'm going to show you how. For those of you that already buy macro and multi-asset funds, I think you'll see that this is something which is perhaps a little bit different and is probably going to offer you something, I would say, that is much more absolute return in nature. And being absolute return in nature, for a lot of people, it fits into that liquid absolute return space because this is much lower cost, much more transparent than most portfolios that you would expect to see there. So the key things to know about this is that we're trying to achieve cash plus 7% before we take the fees out. Those fees down here you can see, very reasonable, 60 basis points, no performance fee. So what we're trying to do over time is achieve a nice strong Sharpe ratio of about 1, and that leads us to try and take a volatility of around 6 to 10%. So those are your metrics to think about. Cash plus 7, obviously we've done more than that. Volatility of around 7 to 8 so far, and very competitive in terms of the return that you achieve versus the fees that you pay. So how is it that we're doing that? Well, we have a group of people who are very established in running macro funds for a very long time. This is not 3 traders who've got good ideas, who put those good ideas into a portfolio. This is about institutional portfolio management, the resources to get this right. We have very deep resources in both strategy and quantitative work, and that's crucial to this. But the key thing is that this guy here, who's my boss, He's our CIO, he's the head of the business, and this portfolio is his baby. This is the one that gets the care and attention and the love at the peak of everything that we do, because it's the most active and the most high conviction portfolio that we have. So the resources of what we do are really focused down on this very active portfolio. How do we do it? Well, it's 3 stages. We generate very key macro themes, and I'm going to show you those in a moment. You can take them out of the presentation and keep them to give you a sense of where we think the world is going. We then select investment strategies to express that view in the most specific way possible. And then we try and risk manage and construct the portfolio in the most robust way possible. I think the one thing that I would like you to take away is lots of people have good ideas. What you need is a structure and discipline around constructing a portfolio that's going to survive through challenging markets so that those good ideas can play out over time. So what are the macro themes that we have here? Well, we have 8 core macro themes at the moment. I'll start at the bottom and we'll go around the world and get a sense of what they are. Global policy divergence, a sense that we're seeing very different behavior from different central banks around the world, and that's going to lead to actually what is a more normal macro environment. It doesn't feel like it, but it is more normal that everybody doesn't behave the same way. US economic strength, a sense that the US is probably in the best position of all of the markets globally to start to see some good growth, and you saw that very clearly in the previous presentation. Supply side weakness, we were very early to this. The idea that the engines of growth, the drivers of growth in America are not what they were pre the financial crisis. The catalysts for growth to be at very high levels again are not necessarily there, and we have to perhaps get used to a more muted growth environment. And that's something that's driven our performance lately. Europe, gradual growth recovery. We're standing in Europe. We do get a sense that we've moved from a low growth environment to one where the catalysts for change are there. And again, I think we were very early to that, late last year, starting to play Europe quite effectively in our portfolio. Low inflation, you'll be familiar with. Japanese economic recovery, I think we're in the 3rd leg of that recovery, which is the faltering leg of that recovery. China in transition, and that theme certainly through August helped us to make some very good returns, and emerging market rebalancing. You'll notice when you look at these themes, none of them are asset class specific. They are all big drivers of market performance in different areas, but the way that you play them will change over time. And that's really key to how we think about this portfolio. We have positions in 3 different areas. More traditional market-linked returns. In a macro fund, if you believe that you have a good sense of a directional position that's going to do well, you should take it. It's not about always being out of the market and sitting in cash. You should be able to drive your returns because you've got a very broad opportunity set to invest in. But then more sophisticated positions, more relative value positions. Currency has been a great performer for us this year so far. And then on the far right-hand side, a sense that you want to tactically hedge your portfolio at times when you think your core view could be challenged. That doesn't mean paying away, buying puts all the time on the S&P and hoping it will save you when things get tough. Very tactical. What's on the horizon? Will it affect my portfolio? Can I hedge for it? Where is that hedge cheap? So lots of different ways to put positions into a portfolio. But let's make that real. So one of the themes we have at the moment is that of US economic strength. And that's relative to the other economies as well as relative to the US's recent history. If I was managing a very simple portfolio in portfolio construction terms, I could exploit this probably through buying a US equity fund, possibly large cap, rotating to small cap. But because I have very many investments at my disposal and I can be very specific how I invest, I have lots of things I can weigh up. So I could say, US economy is going to be strong, I'll go short the long-dated end of the curve. But actually, we don't think in the short term that's actually going to pay out. We're pretty happy leaving duration alone. US high yield, that would be a traditional way of perhaps a slightly more conservative exposure to US economic strength. But certainly with liquidity conditions as they are at the moment, a highly over-owned trade, and certainly an environment where we think as the Fed does go, there'll be some short-term wobble there. That's not something we want to play. So where are we playing US economic strength? Well, we have a small basket of US banks that we like very much, stocks that we think can really benefit at this point in the cycle, where credit conditions are very good for them, and as regulation treats them more like utilities than financial companies, we think shareholders are going to be pretty well looked after. So US banks as a way to play economic strength, something we like very much. Also, something we like very much is to be long the dollar and short a basket of emerging market FX. During the summer, this was a very important trade. Everybody I'm sure you have spoken to lately says, oh, we're long the dollar. But did you ask them what they were short? Because in most cases, they were short the euro. And actually, in August, you lost money. The euro did pretty well. So thinking about the short leg of your trade and thinking actually a strong US economy is actually going to be a little bit challenging for some of those emerging markets and their currency is going to be under pressure. Yes, I like the long dollar, but I also like the short EM FX trade. So thinking through those macro themes and finding ways to play them. But it isn't going to be the same position all the time. Back in 2013 and 2014, actually, the stocks we liked that we were invested in were healthcare stocks in the US. They performed incredibly well. So we've taken profit, and now our position is on the right-hand side in US banks. Long dollar, I've mentioned. During 2013, we were short G10 currency, so particularly euro and yen to fund that. Today, as I say, that's more EM related. And sometimes we're wrong. So we were short US rates in the early part of 2014. We reviewed our investment case for that. It wasn't working. We sold, and actually we bought nearly 8 years of duration following that sellout. Not because of US economic strength, for other reasons, for other macro themes. But we really did review and change our view so that this evolves over time. So think of the sequencing of positions, how a macro theme will play out, and how much flexibility you need to be able to do that. For those of you to take home to have a little bit more color, I've just broken down that theme here into the 2 trades that I told you about and the reasons why we think they're going to do well. So I'll leave that for you to take home and read. A second example of something that we think is a strong theme that's playing out in markets is China in transition. This means how do we position portfolios for the fact that China is going to move from a much more investment-led, very sort of high growth, very cyclical economy, trying to move towards a much more consumer and domestic related economy. That's going to take many years. And during those years of change, there will be many investment opportunities that present themselves. At the moment, 2 that we like very much is that we've been long Australian government bonds. We know that, frankly, the Chinese just can't buy any more Australian iron ore. And on that basis, and many other reasons that the Australian economy is tied to the Chinese economy, we know that that shift to be more internally focused is going to hurt Australia. So very happy to be long Australian bonds, and we think that's a very good position. Where we're short is in European autos. Now, I promise you, we didn't know what was going to happen to Volkswagen. It's very hard to have this next to you after the last week of auto prices. We did not know that. But during the summer, this was a very good position. Because actually, when we thought about investing to be short European autos at the beginning of the year, that was quite a hard trade to put in the portfolio. Because everybody told you Europe was going fantastically well. We were seeing at the sector level, across all areas of Europe, lots of good news. But when we thought about the implications of the transition in the Chinese economy on different parts of the market, we did feel that car companies in Europe could struggle. And so being short that part of the market really has been very profitable. Yes, in recent days, of course, there's been more news to reflect that, but this is more of a long-term theme, and it paid out very well during the summer. And then I mentioned that there are occasional times when you want to hedge your portfolio for the fact that you don't know what's on the horizon, but you do know that it might harm your portfolio. Here's a nice example of what we did during the summer. We did think that the data that was coming out could be a little bit challenging, and we thought that it might hurt our core themes in the portfolio of US economic strength, gradual growth in Europe, and the Japanese economic recovery. So we were positioned for a little bit more good news, and we wanted to hedge ourselves for the bad news. And so the positions we had, we bought S&P puts as they cheapened up, as people were a little bit overconfident in June and July. We had some futures on US volatility, and we also, although we've been very positive on the dollar, we also went long the yen and funded that with a little bit of short dollar. All of those were very cheap hedges going into the summer because people didn't see what was coming. Our concern was that as we looked forward through to the Fed decision-making, markets were going to get more volatile. What we didn't do was just use US Treasuries to hedge the portfolio and say, well, bonds are always a good idea if I think that the equity market might struggle, because actually we felt that that correlation was due to break down. And then looking at the right-hand side, you can see that, yes, that did come to pass. We made significant profits from our hedges over the summer period, and we've taken profits as we've seen things stabilize and hedging become much more expensive as the world has got a lot more nervous. So the tools we have at our disposal are to be very flexible. You can see that at the beginning of the year, nearly 2/3 of our risk was in directional positions that we thought would make us money, and they did. And then as we went into the summer, that reversed entirely, and really only around 1/3 of our risk was in more traditional directional positions. So being able to move around is important. How can I prove that to you? Well, up here, this is our equity sensitivity, and you can see that we had highs of around 45% earlier in the year. That dropped down. In fact, earlier, at the end of last week, it was around 6%. So lots of flexibility there. And I think that this is pretty non-consensus. Beginning of the year, 7-8 years of duration in the portfolio. Again, that made us quite a lot of money. Now you can see very low levels and just nibbling a little bit at duration while we think we're going to see some stability over the next couple of months or so. But I've talked a lot in risk terms. I've talked about long positions and short positions. Actually, this is, in its essence, a core multi-asset portfolio. You can see the types of exposures over time we've had. We haven't liked emerging markets ever, but we are warming up. That's our current position. We're becoming a little bit happier. We've used a lot of flexibility in equity positioning and a lot of flexibility in bond positioning. So yes, we can talk about all the different assets we own, but if we bring this down to simple portfolio management and look at the summary of where positions are, this is easy for you to understand. Our risk currently is lower than it has been. This is the predicted risk of the portfolio, so the ex-ante volatility. And we typically would be around 8%. Today we're at half of that, and we have been really since the end of the first quarter, just taking risk down as the world becomes much more nervous about the progress of rates and how that will affect markets more broadly. Because we have such a broad mix of assets we can use, we want to spend a lot of time understanding how the portfolio might behave. Are we positioned for what we think will happen? Here's 3 scenarios at the moment that we're looking at. We have many, but I've just picked these 3 to show you. Fed credibility crisis. What happens if the world reacts badly to the actions of the Fed? Arguably, that's happening. And in that environment, you can see that we would make money. This is the portfolio at different points in time, and for how we're positioned today, we would make money. If we were to see the sort of steady drop in equities, so not a short, sharp fall, but if equities were to fall steadily, then we would again still today have a portfolio that would be in positive terms. And I think this also shows you how bearishly we're positioned at the moment. If the stock market had fallen 10% for our portfolio at the beginning of the year, we'd have lost money because we were taking risk in markets. But today, for how we're positioned, we would make money if the equity market were to fall significantly. Because we have more flexibility, because our macro themes are not asset class specific, we can find individual trades, individual positions that can help us to put the portfolio together. So rolling all of that together, we've had a return of 17% a year for the last 3 years. That's not the number to look at, because I really don't believe that a sharp ratio here of 3 or 2.5 is sustainable. We expect the returns of beta, we expect market returns to come down, and the volatility of market returns to go up. So doing nothing, investing in the market, is going to have a much smaller Sharpe ratio than we've had in the past. Less return for more risk. And that means that the more relative value, the more diversifying positions we have can achieve the very good returns, but you won't have that sort of tailwind helping you along of very easy market returns as well. So a more normal Sharpe ratio we would expect. The volatility has been steady at 7 to 8, and you can see those returns have been good. I've highlighted here those periods of time when we've seen equities and bonds do badly together, and you can see the portfolio does okay then. Another example, September last year, June this year, August this year, and in that kind of environment, we have the tools for the portfolio to be able to behave differently. However, we will lose money. We're not magicians. This is a portfolio that is just designed to have much lower correlation to more traditional portfolios because of the flexibility that we have. But you can see over the history of the fund, performance has been quite strong. This is rolling 12-month returns. I don't know whether this will translate, but when I looked at this morning, I thought someone had made a grave mistake and put that we were 5th quartile. But of course, there's only 4 quartiles, so actually it's a percentile. Now I understand it. So it just shows you the percentile ranking of the portfolio. So it's right at the top, and you can see that those numbers have been pretty steady in how they've come together. So with minus 30 seconds left to go, I promised I'd be quick. What is it that I think this portfolio can do for you? Well, you will have lots of easy answers in front of you to invest in equities and bonds and to give you your market returns. What you might be looking for is something which can diversify your portfolio and behave a little bit differently. Historically, that's been having to invest in quite complicated and very untransparent portfolios. We give everybody all the holdings of this portfolio. We tell you everything we're buying and why we're buying it. So that transparency, I think, is really important. Having daily liquidity, no lockups, nothing here that makes it complicated, no capacity issues, and most importantly, keeping it very cost effective so that you're not giving up that good performance back to the investment manager and away from your clients. So if we can do all of those things, have a portfolio that is designed to be very diversified, very driven by the quite challenging events that are going on in markets at the moment, those macro themes we hope over time will continue to generate the performance that we've seen so far. So with that, I'll invite the other two back up on stage again, and I think we might have time for some questions.
Tienen una cartulina para hacer preguntas y, por supuesto, también las pueden hacer directamente a los ponentes. Olivia, in the meantime, I'm going to start with you, asking one question. We have seen the capital appreciation that has been reducing risk by reducing the delta and also putting on some hedges. How are you positioned now? I mean, are you going to increase risk? Are you going to maintain hedges? How do you see coming months?
So I think one of the important measures of risk to look at points when the market is becoming quite frothy and a little bit volatile, and we heard about how everybody's debating what the Fed is going to do, but actually nobody knows. I think at this point the Fed don't know until they get to December what's going to happen. And in that environment, you want to not just say, I'm hedging my portfolio, but you want to look at your total exposure and actually reduce your gross risk. Make sure that you have fewer positions in the market, that you're much more convicted around the positions that you do have. And so our gross exposure has come down. Our overall risk has halved. We have very low levels still of duration and equity, and we're being much more tactical about where we're investing. The one area, interestingly, that we are doing a lot of thinking about is whether we reduce our shorts to emerging markets. We've started to do that, and there may be some small opportunities, perhaps in hard currency, emerging market debt, where there may be a little bit of an opportunity, but we're certainly happy to keep the shorts in EM currency and some of those other positions I showed you. Those are very stable. US financials, very stable. So the things I've shown you today are positions we continue to hold.
Sorry, and the next, it's also for you.
That's okay.
This it's about a very well-known fund in Spain, which is the J.P.Morgan Global Income Fund. Some people have read in an article that we had been reducing a lot equity exposure and being very defensive. Could you please clarify what's going on, how we reduce risk, and what is the current income level of the fund?
So the joys of translation, hence what we're doing here, that one version in one currency can be something else in another currency. Mike Schoenhout, my colleague who is the lead manager of the Global Income Fund, was interviewed in London by a journalist last week, and he said, we have been slightly reducing equity exposure in the Global Income Fund. Unfortunately, in Spanish, that came out as we have been significantly reducing equity in the Global Income Fund. So we have only slightly been reducing equity. Let me tell you why. Well, the Global Income Fund is a portfolio which, and in fact, I really liked John's chart when he described the difference between a total return fund and an absolute return fund. And one of the things that he said there was something around moving between asset classes, making sort of cross-asset class decisions rather than actually more absolute decisions. And the Global Income Fund does that. So we would transition between equities to investment grade, long-dated corporates in the US, which is one of the positions how we've reduced equity. We've also bought a little bit more high yield, selectively trying to avoid some of the more distressed credits in energy and so on. So the equity weight has come down a small amount. We've moved it into more high-yielding bond sectors with a view that we're going to see more volatility. The macro views that I've talked to you about are shared across all of our portfolios. The Global Income Fund will typically trade monthly to quarterly. The Capital Appreciation Fund will trade much more frequently. The correlation between the two portfolios is 0.2. So they behave very, very differently.
Manuel, la siguiente para ti. Hemos hablado de esta.
Next question for you. We talked about US, Europe, emerging, but we didn't talk about Japan. What do we think about the Japanese economy? Well, let me think. A couple of answers. First of all, we need to not talk about markets and economy likewise. The Japanese economy is a developed economy that is going to be most affected by the deceleration in China. In fact, in Europe and in the US, practically we won't notice in terms of macro environment. I mean, we're following close what the quantitative analysts are doing and in the different models, but this is one of the economies that will be most affected because China is not growing so much. So the emergent and the Latin American, particularly the Asians, in the whole developed world, is Japan. That is one that had to suffer more after a quarter that has been very disappointing. Probably in the coming quarters, we will see growth that will be very much below capacity, even negative. We're thinking constantly, as you say, there are new measures to motivate and to stimulate the economy on the part of the central bank, and it's really questioning the speed at which this third pillar is increasing, which is the reforms that have been very moderate so far. But from the very beginning, we need to make the difference between pure macroeconomy and the market. The Japanese market is a market where we are very decisive about and it's done really well for us. So as we were saying, we like the developed markets, and I would say Japan is one of the markets where we really like to be. We need to be more tactile, we need to be more careful, because bearing in mind the currency, but you know, we've done very well so far. And the next one is the dollar. Well, as Olivia said, we've been one of those who've been always long in dollar for a long time, and finally the market confirmed that we were doing the right thing. What we've seen is the dollar has covered a long way and it's run really fast in the race. At the beginning of the year, the question everyone was raising is, where are we going to reach parity? And the answer then and there is very similar where I'm going to give now. Even if we see more appreciation of dollar, particularly with regard to euro, what we need to see is a materialization of that difference in the interest rates that we were talking about. So what we saw is that the market in in the cash market and the discounted, we need to think about the interest rate and about the different increases, but we need to have it materialize. Until the Fed doesn't have an increase in the interest rate, it would be different. It would be difficult for the dollar to be stronger. The dollar is very expensive. The movement of emerging currency like Sachs is like 30 and 60%. So there is already been that movement in a number of sectors and scenarios. So people sometimes they increase the interest rate before. So it's the rally that we continue to be supporting, definitely. Jonathan.
That tightening, what can we expect from the fund, from the Income Opportunity Fund?
So, as I mentioned in the presentation, we position the portfolio for a variety of scenarios, trying to generate positive returns in as many of those scenarios as we can. And what's interesting is that the fund has done historically incredibly well when interest rates have gone up. It's not because we're necessarily shorting rates, but because we are trying to take duration out of that portfolio. So today, the fund's duration is a little over 1 year, but it's effectively zero. So even when I think about 2015, when rates rose for, call it 80 to 100 basis points on the 10-year Treasury in April and May, the fund had its best performance of the year. So I don't expect to correlate very much to rates at all. If anything, we are long the dollar a bit. We're short rates on the front end. We expect the curve to flatten. So we're expressing those views that we'll actually make money if the Fed raises rates. We're also short emerging market debt, which we would expect to underperform in an environment where the Fed is raising rates as well. So I think I would generally say I think that the fund can, relative to other alternatives, absolutely perform well. A little bit of that will come down to high yield. So high yield is the biggest risk position in the fund. Considering where spreads are at today and considering the fact that I think that this is going to be highly communicative and that the whole market is going to breathe a big sigh of relief in risk assets, and you'll see equities and high yield rally at this point because there's been so much pent-up ambiguity around the Fed, that I actually think the Fed starting to lift off in December will be quite healthy for this fund and we'll have a positive return from it. But a bit of that is going to be how well the Fed communicates it.
Ninguna pregunta más, ¿no? Bueno, pues yo creo que hemos terminado.
I don't have any more questions. I think we've done. So I do hope that we help you sailing through these markets in problems of high seas. And I hope you gave you great ideas in capital appreciation and ideas that are not correlated and diversifying your portfolio. We have a coffee break, and our managers will be there in case you have any questions, comments in more detail. Thank you so much. And please do not forget to fill out the quality report so we can best comply with your necessities. Thank you.